Welcome to The Explainer. We're diving straight into what I can only describe as a massive, high-stakes tug of war happening right at the very center of the American economy. On one side, you have Home Depot. They are a retail giant executing an aggressive, historic $50 billion corporate expansion strategy. But on the other side, we've got a completely frozen U.S. housing market that is just stubbornly refusing to thaw out. This clash of forces is literally setting up a defining moment, not just for the company, but for the broader retail sector in 2026. So, here's our roadmap for unpacking all of this. First, we'll look at the upcoming earnings catalyst. Second, we'll break down the bull case, Home Depot's undeniable dominance. Third, we'll look at the bear case and that looming housing stalemate threat. And finally, we'll weigh it all out to get our verdict. Starting right off with part one, the upcoming earnings catalyst and why everyone is setting their sights on May 19th. Okay, $38.2 billion. That is a staggering number, right? That is Wall Street's massive revenue consensus for Home Depot's Q1 fiscal 2026 print. But why should you care about this specific number? Well, because this earnings print is widely considered the absolute cleanest near-term heartbeat check we have for the entire housing market. When Home Depot reports, they aren't just giving us an update on how many hammers and 2x4s they sold, they are giving us a real-time barometer on whether the great American housing stalemate is finally starting to unwind, or if we are strapping in for yet another quarter of severe economic softness. To really grasp the stakes here, we've got to look at the timeline. Back in Q4 of fiscal 2025, Home Depot took a hit. Sales declined 3.8% year over year. It was a pretty rough finish, honestly. But now, we are in spring 2026. This is historically the absolute sweet spot, the start of the highly profitable remodeling season. Everyone is waiting on pins and needles to see if that seasonal bump is actually going to materialize. And that brings us to our deadline. Tuesday, May 19th, 2026 at 9 a.m. Eastern. That earnings call is the moment of truth. We'll finally see if early 2026 momentum is actually building or if that Q4 slump was just the tip of the iceberg. Moving to part two, the bull case. We're talking dominance, expansion, and a truly massive bet on the pro market. When we say Home Depot has undisputed power, we mean it. It's staggering. They control a commanding 51% of the U.S. home improvement retail market. Compare that to Lowe's at 28.8%. And what's wild about this is how incredibly stable that lead has been for 2 decades. But it's not just about market share on a spreadsheet. It's about physical, operational density. They operate 2,345 stores across North America. Think about this for a second. Over 90% of the U.S. population lives within 10 miles of a Home Depot. They are practically as ubiquitous as Starbucks at this point. That kind of physical footprint creates an incredibly wide moat that competitors simply cannot cross overnight. But they definitely aren't just sitting back and admiring their retail footprint. Look at the moves they've been making. In June 2024, they dropped $18.25 billion to acquire SRS Distribution. That was the biggest M&A move in their entire history. Then, in September 2025, SRS itself acquired GMS for $5.5 billion, pulling in massive categories like drywall, ceilings, and steel framing. So the crucial takeaway here is step 3. Combined, this platform expands Home Depot's total addressable market, their TAM, for pro contractors by a whopping $50 billion. Why go so hard after the pros? Because professional contractor demand is structurally far more recession-resistant than your average weekend DIYer doing a discretionary bathroom remodel. It's a massive strategic anchor for the business. And their defenses? They go even deeper than that. Did you know over 50% of Home Depot's products are actually sourced right here domestically? Things like lumber and bulky building materials are naturally anchored in U.S. supply chains, mostly because they are a complete nightmare to ship internationally. This gives them a really unique, built-in shield against global tariff escalations. When you combine that tariff resilience with their absolute machine of a financial engine, which generates over $20 billion in operating income, you get a multi-decade dividend track record that recently got bumped to $2.33 a share. Plus, they have enormous capacity for stock buybacks. They are just a cash-generating fortress. Now, we have to flip the coin. Part 3, the bear case. Let's look at the housing stalemate threat, high rates, and some seriously hungry digital rivals. I want you to really listen to this sobering reality check from Home Depot CEO Ted Decker. On their Q4 call, he literally said, quote, "Our customers are telling us that they're not investing." Wow. Talk about a handbrake turn from the aggressive expansion we just talked about. When the CEO of a $164 billion company flat out tells you that the consumer is stepping back, you have to pay attention.
it perfectly frames the absolute reality of the current housing environment we're stuck in.
And you can literally see that consumer hesitation creating this wild financial contradiction in fiscal 2025. Look at this. Total revenue actually hit a record $164.68 billion, up 3.2%. Sounds fantastic, right? But then operating income dropped 3% and net earnings declined 4.4%. They brought in record amounts of cash at the top line, but it completely failed to translate into bottom line earnings growth. This just highlights the intense pressure on margins right now and the shifting nature of exactly what consumers are and, more importantly, aren't willing to buy. So, what's actually driving this bottom line pressure? Well, it's essentially a massive domino effect caused by the frozen housing market. It all kicks off with elevated mortgage rates. Because rates are so high, homeowners simply aren't refinancing to pull equity out of their homes. And because transactions are depressed, people aren't moving into new homes. Now, that's a big deal, because moving is historically the absolute biggest trigger for buying paint, tools, and doing renovations. The end result? Consumers are overly cautious about taking on any financing, which leads to severely suppressed demand for DIY discretionary remodeling. It's a multi-quarter overhang that is quite literally freezing projects in their tracks across the entire country. Now, even with the physical market sitting in a deep freeze, the digital turf war is absolutely on fire. Home Depot is still the heavyweight champ here, holding a massive 43% market share in online home improvement sales, but Lowe's is aggressively trying to close that gap. They've grown their digital share from 17% in 2019 to 21% recently, and they aren't just relying on regular e-commerce either. Lowe's just launched an AI assistant called Milo in partnership with OpenAI to actively capture that hesitant DIY market. It's a pretty stark reminder that even when you're dominating the market, you constantly have to defend your turf. And look, the walls of that retail fortress, they're getting tested from all sides. Sure, Home Depot is insulated from certain tariffs, but if rates escalate broadly across other product categories, that modest price hike strategy they've been relying on could completely shatter. You've also got Amazon continuously encroaching on the home category, direct-to-consumer brands chipping away at their dominance in niche spaces, and the very real, looming risk that tighter credit availability could totally choke off Home Depot's own project financing programs. The threats are definitely lingering out there on the horizon. So where does that leave us? Part 4. The verdict. Let's weigh these forces and look out at the long-term horizon. When you zoom out and look past the immediate noise, the takeaway becomes pretty clear. Home Depot remains the definitive powerhouse of home improvement retail. Yeah, DIY demand is soft right now, and it might stay that way for a bit, but their combined scale, their domestic sourcing resilience, their status as a dividend aristocrat, and above all, that unmatched $50 billion pro-market expansion we talked about, it uniquely fortifies them. For long-term observers, it's obvious they've built a structural fortress that can weather this current housing stall better than almost anyone else out there. Which brings us right back to our final and frankly most provocative question. Will that May 19th print break the stalemate or just extend the great housing freeze? Look, this single earnings call isn't going to magically fix the entire housing cycle, but it absolutely is the ultimate decider of our momentum for early 2026. Will the spring remodeling season finally crack open that pent-up DIY demand, or is the consumer just going to stay firmly on the sidelines? We are definitely going to be watching this one closely. Thank you so much for joining me for this explainer, and I highly encourage you to keep diving into the data.